The recent returns in bonds have been eye-opening for many investors. After a long bull market that spanned roughly 4 decades, we are for the first time in a very long time seeing the other side of that coin, as a resurgence in inflation and the Federal Reserve raising short-term rates to combat it have led to sharply negative returns. As a reminder, bond prices and returns move in the opposite direction of bond yields. So as interest rates and bond yields rise, that pushes bond prices and returns, at least in the short term, lower. Our view on bonds hasn't changed all that much over the last month. The Fed was more aggressive in their actions and communications in June, and results were again negative, but we still think there's a good chance that the worst of the bond sell-off is past us. In thinking about where bonds are likely headed for the remainder of the year, we break things down into 3 scenarios, although 2 of those scenarios are much more likely than the third. Let's start with the scenario that is the least likely, but would also be the most unwelcome. While unlikely, there remains the possibility that the Fed's course of rate hikes would adversely impact the economy, but not have the desired impact on inflation. In that unlikely, but not impossible scenario, the Fed would have to choose between fighting inflation or propping up the economy. If they chose to stay committed to the fight against inflation, bonds would have further to fall. Most strategists, including ourselves, see 2 other scenarios as being much more likely. The first of those scenarios would see the Fed continue on its current aggressive course. Unlike that more dire scenario, however, their actions would be successful in lowering overall inflation levels. Since this scenario would have the Fed continue on its course, and the market has already priced in that course of events, bond volatility would drop, yields would remain fairly steady, and returns would be positive, albeit modest, moving forward from here. The last scenario is similar to the one I just described, but with an acknowledgement that along with inflation falling, we could also see the economy slow to the point of approaching or reaching recessionary levels. The Fed hopes to engineer a soft landing, but there is a very real possibility that their actions will result in a recession. While clearly a negative for the economy and probably stocks, it would actually be a near-term positive for bond investors. The Fed would likely have to reverse course, looking at cutting interest rates, which, since bond prices move opposite to interest rates or bond yields, would increase bond prices and returns. Returns in such a scenario could be meaningfully positive from here, perhaps even recover a good chunk of the recent year-to-date losses. As noted, that last scenario would obviously not be good for the economy and likely stocks. So with that, let's switch gears or asset classes and focus in on stocks for our last segment.